I'm here with Simon Moss, the head of EMEA for Hermes. You're based in London, here in the Middle East with us. You have an interesting mix between investing in a traditional way, but also doing a lot of direct investing. How do you figure out the mix?
Well, we've always, we came from the fund investment side, but we found that that was not effective in terms of delivering the returns through to the end client. And so over the last 10 years, we've evolved a model where basically we invest 50% of our capital into funds and 50% into direct co-investments. And over time, we find that to be a good balance. Typically, we're not paying fees on the co-investment side, we pay fees on the fund side. So you have that fee benefit and also you get more control over your portfolio. We found anything more than that 50-50 mix, it affects the quality of deal flow on the direct side because you don't have partners who wish to supply you with deals. But that sort of 50 to 40% direct we find works well.
Mm-hmm. And how hard is it to find the right co-investment opportunities?
Well, I think the challenge is really, ensuring you get sufficient supply and also obviously maintaining high quality. So we sort of have an open door policy, if you like, that we try and generate as much flow as we can from the GPs globally, and then we try and have an effective screening mechanism of getting down to those deals. So typically it's sort of 1 in 10 deals we do. Now to achieve that though, you have to really ensure that when you're turning deals down, that GPs take that in the right way. But that's really what we're driving at.
And how different is the diligence process? What do you have to focus on that may be different than what you would with a fund?
Well, I guess I'd say the direct diligence is very different from the fund diligence. I suppose we really see ourselves as stock pickers, if you like, in the public equity sense. So we're trying to strip down a particular buyer opportunity. We typically have access to all the information and the research the GP has commissioned, and we're trying to understand the drivers of return on that particular deal. So it's obviously very much more company, stock specific. See, as we evaluate the co-investment opportunity, we also evaluate, or we already have a strong view on the lead GP. But really it's that consistent analysis of the deal in terms of the growth of the market it's in, the company franchise, the valuations, the debt structure, and then the manager lead GP. But it's that consistent application of that approach to each co-investment opportunity. I mean, the fund side, in terms of analysing the funds, it's a much more qualitative thing around the individuals within the GP, and it's a lot more sort of that sort of interpersonal dynamic, and also that sort of looking forward trajectory of that particular team and the leadership of that team. It's very much more about just analysing how effective you think that team will be over the next fund life.
It's clear that fees and sort of a lot of the debate around fees has driven more people into co-investment. Are you seeing more peers get into this line of business?
I think we have. I think basically what happened with the global financial crisis, you'd seen a very strong performance from private equity, and so LPs were satisfied with having a diverse fund portfolio. I think then it was the first time a number of LPs experienced bad returns and seen how volatile the asset class can be, and hence there's pressure from trustees and their end clients, if you like, to sort of try and add further value to portfolios. So we've seen a big upsurge in interest in LPs thinking, okay, how can they get more control, how can they be more direct, how can they drive down fees? So I think LPs are coming at it from different perspectives. So some of them are saying, we just want to reduce fees, so we're going to have a sidecar alongside a fund. Where the GP will give them that because they're a big investor. Others are applying a more sort of LPs are trying to cherry pick effectively from deal flow supplied by GPs. I mean, I think it's the issue is really whether you're doing co-investment to try and get control and try and build the portfolios that you want, or you see it as a pure fee discount mechanism. And we think if you're seeing it as a pure fee discount mechanism, then you're a big LP, you should be able to negotiate that with the GP. And it's a bit of a sort of roundabout way to do it through co-investment, and we think that's a bit dangerous. So we think it should be seen as a sort of value-add exercise around picking good quality direct opportunities to sit alongside your funds.
Very good. Well, thank you so much for the time.
Well, thank you.
Simon
Thanks very
Ross
much.
from Hermes.
Thanks a lot.